Well, gang, come on in, settle down, familiarise yourself with these faces, because no doubt you'll be asking them for money over drinks in about half an hour. We are going to talk VC trends and opportunities. And with an extraordinary cast of venture capitalists, in terms of Ron Spector, who is the founder, of course, of 1835i Ventures, Toby Norton-Smith from the CBA's X15 Ventures, Amanda Angelini from NAB Ventures, James Cameron from Airtree, and our fantastic moderator is Anthony Boogert from King & Wood Mallisons. Over to you guys, bring it home, finish our first day of Intersekt. Thank you.
Thank you very much. So I'm very conscious that this is the last session before drinks, so we are going to make sure we don't go over time. And so we'll get straight into it. We'll start off with just some intros. So Ron, do you just want to tell us a little bit about 1835i?
Yeah, good afternoon, everybody. Hopefully you're having a good first day. 1835i is the venture capital and innovation partner to ANZ Bank. So we spun out about a year ago. Used to be called ANZI. We are now 1835i, which was actually a combination of the year the bank was founded, got its royal charter in England, and the I to carry on the investing and innovation theme of what we've been doing for 5 years.
Hi there, everybody. Amanda Angelini, NAB Ventures. So NAB Ventures is the CVC arm for National Australia Bank. We've been around since about 2016, obviously investing in companies from sort of seed through to later stages, primarily a strategic investor and looking to partner with most of the companies that we invest in.
I'm James Cameron. Thank you. I'm a partner at Airtree Ventures, and we're a VC fund focused on Australia and New Zealand. We have around 1.3 billion under management, and we're a generalist investor. We're not a specialist in FinTech. We do everything from FinTech to healthcare to enterprise software. I think the thing that probably carries across all of the portfolios, we try and invest very early in companies that don't have a lot, a couple of people and an idea most times, seed stage, and then have the ambition to grow much bigger. In FinTech, we have invested in companies like Frankie One and Prosper and Athena, Mr. Yum and many, many others. We also have a dedicated crypto fund, so we do a lot of Web3 stuff, including things like Immutable.
Good day, everyone. Toby Norton-Smith from X15 Ventures. We're a venture arm of CommBank. We've been around for less time than everyone else, probably about 2.5 years. We launched just before COVID got very serious, maybe in the last physical meeting you could possibly hold, which was good timing. We're not actually a VC, which is probably late-breaking news, but I'm on the panel now. But very similar, actually, in objective. We call ourselves a venture scaler. We buy, we build, we invest in ventures, always with that strategic opportunity in mind of how we can help ventures tap into CommBank. So if I'm not off the panel, looking forward to the discussion.
Thanks, Toby. And my name's Anthony Boogert. I'm a partner in the private capital team at King & Wood Mallisons, and we represent fintechs and investors in private funding rounds and other corporate transactions. But I think everyone's here to hear about the investment environment. So I know James was quoted in the AFR yesterday about saying that, actually, are we not really in a funding winter, and we're actually ahead of where we are than 2020, and really, so was 2021 really an anomaly year, and is actually this year better than you think?
Yeah, I think it's always nice being the poster boy for the entire industry falling off a cliff. But I think in reality, if you do look at the numbers, they're very different year on year from last year. They're still well above long-term averages, and I think that says a lot about the state of the market relative to where it was 3-4 years ago. When Australian VC was really just getting off its the first generation, the sort of in its infancy in the dot-com crash, a global recession pretty much wiped out the entire industry, not just VC, but tech in general. And I think I've had a lot of questions recently around what a sort of prolonged pullback in the markets mean for VC in Australia today. And I'm much more optimistic today than I think any of us were back then. The reason being there's so many more companies that have broken through. There's so many more investors This is just a tiny subsample of the total number of venture capital investors and the types of venture capital investors, be it CVCs, corporate venture capital, institutional VCs like ourselves, Airtree, seed specialists, angels. There's so much more depth in the investment landscape and so many more experienced founders that are now going through their second, third, fourth time in many cases and now giving back their time and energy back into the ecosystem. There's also been many more exits. We've had lots of exits over the last couple of years alone in many of the companies that are the strongest performers in Australia. There's a lot of secondary sales that have come through, so a lot of money has gone back to the LP base. And so I think that all of that breeds resilience in the ecosystem that leaves us with a lot of confidence that with this sort of dramatic pullback, and there has been a very dramatic pullback, especially in the public markets, we'll pull back on the funding amounts coming into the market for a little while, but most likely along this returning back to a sort of trend that was happening well before 2021 happened. And I think 2021 will stand out as a real anomaly in terms of the funding amounts, especially into the growth stage deals. And it will probably also stand out as an anomaly in terms of valuations that certainly pulled back and the cost of capital has increased. But overall, it's come back, I think, to what is a nice upward trend overall at the averages.
Thanks, James. So, Ron, Warren Buffett often says, be fearful when others are greedy and greedy where others are fearful. Clearly, many people in the market are fearful right now. How are you thinking about it?
Sorry, I couldn't hear you quite clearly.
How are you thinking about the current investment environment? Are you looking to deploy capital or you're holding back?
No, absolutely. I think I would agree with James that the market is a mature state now here in Australia. I've been through these cycles 3 or 4 times back in the US, and I think the industry is mature and you're seeing a mature response. So valuations have come down. I think deal deployment in terms of capital has slowed, but I don't think it's going away, especially early stage. And I think we're in a position where as strategic investors, at least 3 out of the 4 of us, this is opportunity time for us. We have a strategic thesis. We want to invest in leading emerging growth companies that can bring value to our parent and its customers. And this is a time when valuations have come down. The need for capital hasn't decreased for these companies. So we see it as a really good opportunity to accelerate our efforts and invest and try to find those strategic relationships and partnerships.
Thanks, Ron. And Amanda, how do you think about what NAB Ventures can bring to a portfolio company relative to, say, another institutional investor?
Yeah.
This is where we get to jump on James.
I figured that, actually. I was going to say, I just agree with everything that Ron said, and we'll see what James has to say. Again, I think we're also looking at it the same way, right? We see a lot of opportunity at the moment. The positives of CVC is that not only do we bring capital, we're also bringing, in most instances, something ranging from a proof of concept all the way through to a commercial partnership. So you're bringing capital, but you're also bringing an ability for those companies to increase their ARR, which then usually allows them to go on and raise, at a higher valuation in the next round. And, financial services, the reason why we're all here is there's still an enormous amount of innovation to happen in the financial services sector. And there are a lot of companies out there that have, come along and are trying to help our parent companies provide the best products and services for the customers. And that can be small C consumer all the way through to our institutional customers. And so I think, as Ron said, we're out there, we're active in the market. We do try and look for that strategic relationship early. One of the things I think we've had a fair amount of success is just making sure that we have buy-in from our executives and primarily from the business leaders that are going to be working with those customers, because it's a partnership, it is a long-term partnership, it's a marriage.
Thanks, Amanda. And Toby, you were saying earlier that X15 is not even a corporate venture capital unit, it's something else. Can you please explain that?
Yeah, very happy to justify my presence here. Look, we do make investments. When we invest, we don't do it through a closed-end fund with the GPLP structure. We're investing off CBA's balance sheet, which has obviously its own pros and cons. Look, I think maybe I'll pick up from where Amanda left off. I'd agree. Like if you look back at the track record of CVCs, and I'll lump ourselves in for now on that. The objective is relatively similar, right? It's that how do you identify that point of strategic leverage, that opportunity to bring the scale of a corporate, be it through procurement, partnership, debt funding, whatever it may be. How do you bring that to life? I think, if you look through the portfolios, globally, the conversion rates, strikingly poor on delivering on that promise. So I think we're all chasing the same promise. I think, where we started a lot later and have probably tried to focus most on is how we can bring a slightly different offering, which is sort of technology and compliance services. They don't always sound like the most attractive combination to our ventures in the portfolio. And so, X15, we call ourselves a venture scaler, which sort of gives away what we think we're about. But we operate on a platform of people, of technology, of operations, which we call X-Stack. And the promise that holds out is sort of in two parts. One is to help a venture scale. But when we're talking about scale, we want scale that is repeatable, that is consistent, and that's scalable. And so, we believe we need to do that through technology. So we spent a lot of time on building out the right integration points into CBA, be that to consume services from the bank, be that to access customers at relevant moments. So that's promise one. Two is, really back to the parent. And I think we all have similar challenges here. It's providing the bank, with the right assurance that those ventures, when they plug in to the corporate asset, can sort of meet the obligations that the bank faces and needs to meet for its customers, which is sort of the enduring challenge of how you bring great ventures and great new products into, more regulated, more conservative environments. And again, as much as possible, we're trying to solve that problem, through technology, through, monitoring and assurance that ventures, without us getting in their way, are deploying code in correct ways, that we can demonstrate, not document, that their architecture is sound, that we can ensure their workplaces are secure. That's the sort of area we focused on. So probably a slightly heavier investment in, a big central team that drives that engine. We do invest, but I think like many of us here, we're happy to follow or actually, follow the expertise of other VCs to sort of identify sometimes what the right opportunity is.
Thanks, Toby. James, your right of reply after having been ganged up on by the three around you.
If you've ever wanted a bigger bear market signal, it's having 3 corporate venture capitalists and 1 institutional VC on a panel. You'll know that we've hit the bottom when it flips around that ratio. The beautiful thing about being an institutional VC is I'm accountable first and foremostly to my founders. LPs, obviously we are paid to return money to our LPs in many multiples of the money they give us, but the way we do that is by being accountable to our founders and working hard for them, and everything else sort of will play into that as long as we get that piece right. And so I think when you're out looking for capital, I think there's probably 3 things you're effectively buying. You're buying money, which is the most commoditized asset on earth. You're buying support and you're buying alignment. And I think support comes down to the different type of how different organizations optimize the level of support. Well, I'm a generalist investor. I'm not a FinTech specialist. So I am always going to be out there providing generalist support, recruiting, strategic planning, how to do fundraising, US expansion, etc. I could never dream of being able to help you in the same way that these guys can when it comes to navigating the various levels and the politics of getting into banks, financial regulation, all this sort of piece. And so as a result, many times, and we've co-invested with all of these funds and have had good experiences in each case. A lot of the times you are optimizing at different parts of your journey for that different level of support. But I think I don't want to sort of overweight the support. It's a key part of the decision, but that third piece, that alignment, is also key. And finding someone who you are aligned with in terms of the belief, someone who you trust and someone you can work with, and that can be anyone. That is much more of an individual relationship-based thing. And as I said, I've invested with all of these investors, and I know that we are all really focused around that relationship building and that trust building as a core element of all of our investments. Because if you don't have that, it's a hell of a long journey to be misaligned. And when I say aligned, I don't mean someone who's going to blow smoke up your bum for 10 years as a journey. I think you can't have someone that's just out there cheerleading, but you do need someone who is aligned and that you trust and who believes in the overall vision of where you're going and can be used as a sounding board to try and bounce ideas and sort of sometimes tell you where things sound crazy and otherwise sort of really encourage you up, because there's some hard times as a founder, as all the founders in this room will know.
Thanks, James. So let's turn now to where we're all looking to deploy capital. So I'd first like to ask, Amanda, where are you focused? Where do you see the most opportunity in the next 6 to 12 months?
You listening? Ready? We're going to. So as I said, right, so we range all the way from ag tech, prop tech, all the way over to blockchain. And I think that we're always looking for companies that can either partner with us, and it could be back-end technology, or frankly, it could be, direct to customer, small C or institutional. And at the moment, we're finding, some of the things that we're interested in are sort of the embedded finance space. I think SMEs are always struggling to find ways that they can actually spend more time on their business versus, doing accounting, doing finance, doing whatever else it is. And that's been around for a while, but I think that there's still a lot more room to grow and to find ways in to help them. Just based on the panel that we're coming after, digital identity, everything. I mean, there was a fraud panel, a cyber panel earlier today, and this is going to become, I think, more prolific as time goes on. Just the fact that we all spend most of our day on some sort of a device. So digital identity and allowing people to kind of own that and keep that safe. Data is always a big thing for us. Banks have a lot of data. Other companies have data. Like, what do we do with that, and how do we make that work for our customers? And because we've seen a lot of payments people here today, I have a little bit of a particular bent to payments, but we're always looking kind of for opportunities in payments, and that can be, again, from sort of merchant services, all the way up through to sort of the large institutional customers. There's many more, but I'll see what Ron's looking at.
Probably the same stuff.
Toby, how about you?
Yeah, I think when we look at, everyone's made the point on strategic alignment, so it's a combination of a top-down exercise of making sure you're investing and looking at places that, in our case, our LP it cares about, but then also doing the bottom-up work to find, alignment with a founder, with a team or a venture that's sort of, happy for the model that we offer. So, I think it's actually, in many ways, business as usual for us. I'd say some of the areas that resonate for us, any of the sort of big macroeconomic challenges that really the country faces, CommBank and its customers face. So, home buying, that end-to-end journey, we've made, a bunch of investments in. Many of them, I think it's resonating. I'll pick the example of a digital conveyancing service that we actually built. We plugged that into the CommBank app at the right moment, and the sort of take-up rate inside the app increased 10 times for that service. Customer sat really high. So we're quite motivated by finding those journeys that already make sense to a customer of CommBank and then plugging them in at the right time. So, home buying, employment, many of the areas, Amanda mentioned, I think, really, really matter. The other point I'd make is, banks, obviously everyone looks at banks as enormous sort of profit pools, and opportunities to go after to sort of bring new customer service offerings. They also represent enormous cost bases. The OPEX of CommBank is, about $11 billion a year. It's, larger than the profit pools. So again, I think there's so much opportunity there. We've spoken about sort of payments and embedded finance. The evolution I'm seeing and excited about is if sort of version 1 of a lot of that functionality from, many fintechs was some version of, helping, originate and onboard a customer and then provide basic rails. I think version 2 is how services in this room are starting to provide technology and automation around, back office functions, often where the real cost and where the actual real separation in performance of banks can exist. So that just gives you a flavour of some of the stuff we're looking at.
Very interesting. So I think let's turn now to sort of areas that you're steering clear of. Ron, when we caught up beforehand, you gave your totally unbiased view on neobanks. curious to hear more about. And there's obviously been a lot of media attention in that area in the last 12 months or so.
You were asking me in this crowd to talk about neobanks. Thanks. Look, unfortunately, there was a proliferation of new businesses that we all hoped would be successful because, quite frankly, whether you're CBA, NAB, or ANZ, if the customer experience qualitatively increases, it causes all of our parents to have to up their game and provide better products and better services to the Australian consumer. So I think what we saw was a proliferation of companies globally that were attacking a problem, whether it would be FX, whether it would be supply chain financing, whether in the US, student loans. You saw companies arise that were solving a specific problem where there was massive inefficiency, and usually costs were just out of control in relation to the customer experience. And I think they've been really successful in scaling those businesses. I think what we saw here in Australia, we saw it in the UK and a little bit in the US, was I want to be a bank, which means I need a license and I have to have all the regulatory compliance issues. I need people to give me their money so I have a balance sheet so that I then in turn can lend, which is where all the profits of these organizations are derived, not from just holding an account or providing a great app. And we looked at that early because they all came in to raise capital from us early on, and it was really difficult to see how they'd be successful in a general market, let alone when there's a market correction, which we're experiencing now. So when cost of capital goes up, when there's stresses in the system where capital evaporates in terms of availability for alternative lending, we saw that as just a rough sea, and you need a balance sheet. You need to have years of being a regulated ADI in Australia to survive these markets. And I think, unfortunately, you've seen most of them either sell or close their doors or pivot to selling their technology. And personally, I think it's unfortunate. Not unexpected, but unfortunate. And I'm hoping that the next wave can take more of a point solution. I think we're seeing some of that with the work in Unloan that CBA has done. We've backed a company called 1-2 Finance, which is really trying to create a digital mortgage process that's fundamentally different. So I think in the market there will be solution providers that will come back up, but they're not going to try to take the whole thing and try to really go down that ADI path, especially in Australia, which is a very overbanked market. There's a lot of banks here for a very small population. So unfortunate, but not unexpected.
Maybe if I could just add one more. I thought that was a really good summary, Ron. One more B to the equation. I think, not always a popular opinion to express in this room, but I think we've seen the importance of balance sheet. We've also seen the importance of brand, and so to draw on the example, Unloan's a digital mortgage business that we chose to build in X15 and launched, in May. It leverages those integrations I discussed, so it consumes payments, account, customer APIs from CBA, and therefore inherits compliance, treasury funding from CBA. So, and the ability to say, backed by CommBank. We've found it's early days, but both balance sheet is obviously advantageous, but actually the importance of brand. Now, brand is nothing if you can't stand behind it, but if you can say, hey, this product has been, built by, assured by, we're finding that's really helping in customer consideration. And I do think that is one of the other challenges, is, how you scale about a brand that really appeals to, large, middle markets of customers as well.
So James, when you're looking at fintechs, would you have a preference towards an unregulated business to try and stay away, or you don't? I mean, obviously there's a big difference between an ADI and maybe it's just payments business or another licensed business. But
I'm extremely open-minded about it because I think the minute you try and sort of box yourself in one way or another, a founder will come out of left field and surprise the hell out of you by making something work. And I think in that sense, we're almost proudly anti-thematic, and not just in fintech, across all of what we do. If you took a sort of McKinsey-style analysis of the Australian market and tried to identify where the next great startup would come from, you would probably find financial services or ag tech or mining tech, but you would have missed the Canvas of the world. You would have missed Atlassians as well. There's no way that you will be able to identify the real outliers by focusing too heavily on a specific thematic. And so as a result, we try and force ourselves to be open-minded in that. That said, we obviously want to come into these conversations with a prepared mind, and we spend a lot of time sort of digging deep into some of these thematics so that when we do see something that comes across our desk, we can try and connect the dots, not just from FinTech, but from all the other businesses that we look at as well. And I think one of the failure modes that we have seen a few times in the Australian market is businesses that are trying to import models wholesale from overseas and try to apply it to the local market without making those adjustments that you might need to take into account regulatory changes or competitive changes. And the neobanks are a great example. There's been some challenges just by virtue of the fact that interchange is so heavily different here than it is in the UK and the US, and it requires much more capital. It's much more difficult to build those models. But we're already seeing some of those, and I encourage founders to think about when they are looking at these models, and if you do want to set out to build a neobank, and I think there's a really, really good opportunity in Australia to build some of these, is to leapfrog some of the models that are happening overseas. I'm seeing some phenomenal stuff that has Web3 as its core, that is building for a new set of customers that doesn't really know or care that Web3 is at the back end of it. And that unlocks an incredible amount of opportunity to build products and features that the neobanks that we had in the last 3, 4, 5 years would never be able to unlock. And so I would sort of encourage people to sort of not accept the meme that neobanks won't work in Australia, because it's bullshit. Something will surprise us, and it's all about keeping an open mind for when that does happen.
Can I just add
Sure.
one thing on that? And I think it's just about understanding the customer here in Australia. And if you look at South America, if you look at Africa, so we're a global investor. Obviously, this is Australia, so we're talking about Australian startups. But there are business models for neobanks that are in other parts of the world that really do make sense. And it allows people access to basic banking that everybody here pretty much takes for granted. And yet it's really, really difficult for them to be able to literally pay their electricity bill. And so I think, to James's point, really understanding the customer base and what is going to be of value to the customer base when you're already sitting in a country where, going to open a bank account isn't as difficult as it is in many, many other parts of the world.
Thanks, Amanda. So I think it looks like we're at time, so I might open it up now to questions from the floor.
Come on, there's got to be some questions beyond red or white wine. No? Going once? Going twice? Oh, okay. You just want me to get my step count up for the day.
Thank you. So when you're being pitched a new idea, how quickly do you make up your mind? Are you going from gut instinct? Is there something you're looking for, and any red flags?
The question was, how quickly do we make up our mind? So many things that question depends on. No, there has absolutely been cases where I've made up my mind very quickly, and there's others that we've got to know founders over the course of 2-3 years sometimes. And so it's a real sort of piece of string type question. I think by and large it really depends on stage though. I mean, we do 96-7% of our investments, our initial investments are at seed stage, and the vast majority of them are pre-revenue and in many cases pre-product. So there's not a lot to go on when you ask for a spreadsheet with all the metrics. It doesn't exist. And so then it's really about team and dream, and that's about getting to know the founder on an individual basis to try and identify what special insights they have on the market and actually what's driving them. What are the motivations that they are that are pushing them along to build this particular product? Because as we know, this is a long journey and there's loads of ups and downs, and those ups are high, but those downs are low. And so knowing and understanding what makes that founder have the motivation to push through those is incredibly important for us. And we spend almost all of the initial meetings that we have with those founders try to understand those ambitions and those motivations.
I'll take a crack for the strategic side. We have a more challenging job, because before we get to that analysis, we have to decide if what they're trying to do is within our strategic focus area and is going to be a potential benefit to our respective organizations who's deploying the capital. We're doing that for them. So we have to make that strategic evaluation first. Now, we can do that relatively quickly. It's thesis-based. We kind of know which areas we're investing in, which look a lot like the ones that were already discussed. The second part, I would agree with James. It's if you have a team coming in that's been there and done it before, and I've fortunately in my career, I've been on James's side longer than the corporate side, and when you have an entrepreneurial team coming in saying we're doing our third and you know us, it becomes a very easy equation because you can get to a yes much faster. If you don't have that experience in the team and that trust in the team, you have to develop it, and that takes the time that James is describing. You have to spend as much time as you can to really understand their capability, because in the end, we're not investing in the TAM, we're not investing in the tech, we're investing in the people. And I know that's a cliche, but it's actually true. In the end, I don't believe the TAM, and in the end, I assume the technology is going to work. And if not, you're going to figure out how. But it's all about that team and our belief that they have the right vision, and if not, they're going to know how to go after the vision that they have to achieve to essentially get the strategic value we're looking for and return our capital.
On the team piece, I always tell our team that sometimes the best time to meet founders is when they're not raising, and really get to know them and spend a lot of time with them when it's not under the pressure of people actually really, really needing to raise funds, or they've already got a lead term sheet from someone, and there's a time limit now on when you have to do your work. And to Ron's point, we can take a little bit more time sometimes with the work that we need to do, but I think it's always a good time to meet with VCs, and it's always a good time for us to meet with founders and just get to know people and get to understand what they're trying to do, because it really is about the people.
With no pitch deck.
Well, no, it's more fun if there's no pitch back, right? Yeah.
Now they're all keen. I'm going to ask a quick one as I go up there. How do you respond to the question that was, or the proposition that was put to me that 2021 was the year of VC FOMO? And have you guys ramped up your due diligence consequently in 2022?
I think it was last year was the year of FOMO for VC. And have you now ramped up your due diligence?
I think, at least I can take a shot at that. I think we do about 1 or 2 deals a month, and that hasn't changed over the course of the last 4 or 5 years, really. There were definitely situations where you had to do that work a hell of a lot faster in the last year. In fact, I think the overwhelming feeling from most VCs I speak to, is particularly the growth funds in the US, is one of almost relief. A lot of their portfolios are completely underwater, so they don't want to think about that, but they're almost relieved in a sense that they can actually get to know founders a bit better and take more time to make these decisions. But the good VCs, certainly the ones who had super funds or pension funds or endowments in the States to answer for, were doing the work in a much more compressed time frame, and it was exhausting, frankly. There were times when we would see companies on a Monday there was a few times last time where we were having to sort of wrap up the same amount of due diligence, the same customer calls, the same modelling work that we'd do for a growth stage follow-on investment from our own companies. So we even had a bit of forewarning that it was happening in the course of about 3 days, and that's. You don't sleep a lot in those 3 days, but by and large, you get much of those diligence done. Nowadays, we have the opportunity to get to know and build the relationships before you have to click into that DD mode. And when you're in that DD mode, you've usually got a few more weeks, which frankly is a massive coup for work-life balance when it comes to being a VC. I wasn't complaining, I love my job, but that was pretty intense.
So, James, we've heard about you and Airtree's Web 3.0 fund, but given we've got 3 of the big 4 banks, CVCs on the stage, it'd be interesting to hear from them about what the big 4 banks and the venture arms think about crypto, digital assets, Web 3.
You want to start, Ron?
Sure. For those of you that heard the panel earlier on stablecoin, you've heard some of the things that ANZ's doing, and Nigel Dobson was on the panel. So we're actually looking to support the institutional side of ANZ in their stablecoin ambitions, in using stablecoin for carbon trading markets and other use cases for customers. So we're very much focused on that sector. We are also very supportive and are actively paying attention to what's going on in the Web3 space. I think if you look at crypto as a concept, or Bitcoin or other cryptocurrency as a repository of wealth, we are staying very far away from that. There's just not an ambition within ANZ to pursue things around that outside of the use cases that they're being built around the stablecoin environment.
I can't say anything that's too much different. But so again, NAB's focused more on the institutional side than on the personal banking side as it relates to this. NAB Ventures made an investment earlier this year in a US company called Amber Data, which is, I think the easiest way to describe it's probably a little bit like the Bloomberg for digital assets and kind of that entire space. It allows us to really see exactly what is going on, even if we're not, participating in it, but definitely more focused on institutional. I think there's a difference between, the underlying technology and blockchain and what that can do in areas like carbon credits or in ag or in, other subject matters versus, just looking at, the crypto assets, digital assets, which is not, what we as a venture firm, are looking at.
Yeah, I mean, sort of ditto those points, not too much. We're pretty focused on those points of leverage that we spoke about. And so to the points on, crypto, for X15 at least, we see, more opportunity of sort of models that are probably ripe for bringing to customers that we'll focus on. So it's a very similar answer to my corporate peers.
Great panel, thank you. My question is about diversity in funding. We've seen a lot of strident criticism of funding of female-led projects, female-managed, projects. And, there's other areas, right? So whether it's other minorities that aren't seeing that funding. I was curious as to whether or not any of you've got any specific initiatives beyond awareness training, but just specific initiatives around how you fund, who you fund to start to shift that needle away from, we're going to call it straight male white funding.
Yeah, I'm happy to throw a few thoughts there. It's something we're incredibly conscious of, the challenge, and wouldn't for a second profess to say that we've got the answer. The law of percentages will sort of misrepresented. 40% of our founders are female. That means 4 of 10. So I sort of don't want to overestimate that. I mean, for us, one of the points harking right back to my sort of confession at the beginning that we're not a classic VC model and not equity incentivized, I think there's something interesting for us in the slightly different risk return profile that we offer out to founders and ventures. You think about that trade-off of, a little bit more assurance from the venture vehicle, a little bit more support to plug in. So it does change the risk return profile a bit. We've found that has helped attract, not just at the founder level, but within teams. We track pretty well on sort of, a few metrics of diversity that we measure. Beyond that, I'm sure everyone's got some views on this. Another thing, we love partnering with, organisations like, Startmates Women's Fellowship. We find tremendous talent who are sort of looking for that opportunity, often who are in corporate, don't have the privilege or the presumption that they can launch straight into the all-in equity model and the sort of X15 model, be it inside the core team or inside a venture, is a sort of nice stepping stone. So again, don't have all the answers. I think there's a long way to go, but that's one thing we've thought about is the incentive balance.
And Amanda, do you have something to add on what NAB's doing there?
No, I'm just so happy that somebody asked the question because I was trying to work out how I might be able to weave that into the conversation. But we do definitely focus on that. And I think most of us have probably read the numbers, that are in the diversity bucket and can see the low percentages of capital that actually goes to diverse founders. And that's just not female founders, that's diverse founders. I'm proud to say that we've made a number of investments in the last 12 months with at least, one female founder. That is something that we look at. I think we still have strides to go. Half of our team, we're a 50-50 team. So we hope that will help us improve. But we have work to do, but it is something that we're very conscious of.
Can I just add a few? Because I think one of the numbers are shit. that's really, really poor. And I think the numbers, everyone tries to get a free pass by sort of identifying female members of founding teams and counting that as a block of, yes, we've ticked the bucket. If you actually look at the numbers, just purely take all the founding teams and split it up on a gender basis, the numbers are worse than the numbers you often read. So the numbers are terrible. And it is something that absolutely needs to change. And I think the way we think about trying to change it, and we are part of the way through a long journey of this, both at Airtree and I think as an ecosystem. It has to change at the top of the funnel and the bottom of the funnel. I think the way we think about it, at the bottom of the funnel, you need to have diverse voices around the investment table, which means you need to have investment decision makers which are diverse. You need to have partnerships which are 50-50 or close to it. And that's one of the things we've been very focused on, is making sure that we've got investment decision makers, an equal split amongst the partnership that are making investment decisions, because that's where it starts. But even then, and we've had that for now 3 years, even then, that only slowly changes things, because then you've got to focus at the top of the funnel. And the top of the funnel is where you can encourage more and more female founders to think about, before they're even founders, to think about jumping into the space. And that's where we've been really trying hard. We've got a program that we've launched this year called Pioneers, which is finding people who haven't even thought about shorting companies for whatever reason, and just encouraging them to network amongst their peers who have, and amongst each other, and having the support network to do that. And they may never do that, but some might. And that sort of creates at the top of the funnel. And then there's the middle bit of the funnel, which is the earliest seed stage investors. And one of the big focuses we've had over the last couple of years is trying to improve the diversity amongst angel investors. Because if you don't have diversity amongst angel investors, then there's a big chunk of this investment stack that doesn't have the diverse voices you need. And if you think the VCs are underrepresented when it comes to women, you should look at the Australian angel market. It looks like an old American university football team photograph. They are all old white dudes. And the more that we can get to encourage women into angel investing, the better we have. And there's a big chunk of what we're doing with our Explorer program is to make sure that that is an opportunity that is open to more and more people.
Thanks, James. Ron, any final thoughts before we wrap up?
No, I think all of those are really good points. We're committed to trying to increase the diversity and help coach and train up the next generation of female investors. But unfortunately, we're not a seed stage investor. So what we're trying to do is support organizations and try to support the organizations that are trying to train and coach up and create the entrepreneurs that then can come through that pipeline that James was describing and then be available for us to invest in. So I think we're trying to approach it as being part of the ecosystem, though we can't directly do what an institutional fund can do and go early stage and try to create those vehicles. But yes, we are absolutely, and I agree, I think it's great someone brought it up, and thank you. And it's a long-term multi-solution. There's no silver bullet here.
Okay, well, look, I've completely failed everyone by going over time, but so let's please put our hands together for the fantastic panellists and Intersekt.
And thank you to Anthony.